The topic of this video is in regard to swing trading. And usually I'm not a swing trader, my strategy has always been a long-term one. But sometimes swing trading can offer better reward than risk and can make sense from a statistical point of view. With the market prices of many cryptos booming lately, there is a lot of volatility in the market, and this means that there are a number of days where the price routinely moves up and down by 5 or 6% per day over and over again. And the other day I decided to take a chance on one of these swings and sell my entire VET holding and try to buy back at a lower price. And I managed to buy back at around 7% cheaper with a profit of just under $5,000, which isn't bad for a day's work. And by the way, I'm not saying that it's easy or that there isn't any risk involved, as it definitely is. But sometimes the market does offer bets which have odds which are heavily in the investor's favour. When we go into a casino, the odds are always in the house's favour, and that's why betting in a casino is generally a fool's endeavour. But in the crypto market, there isn't anybody setting the odds. The odds are determined by free market forces of supply and demand. And occasionally the market does offer odds which are heavily in the investor's favour. For example, I noticed that the price of VET was bouncing up and down by a few percent many times over and over throughout the course of the day. And so I wondered whether I could exploit that trend and capitalize on the opportunity in some way, and also what the risks involved were. To me, the risk was clear. If I were to sell and the prices were to rise instead of fall, I wouldn't get my re-entry point, and so I'd have to wait to get back in, or I'd have to take a loss and buy back in at a higher price. But because this trend was happening over and over again, I figured that the risk was very low, and that I would be able to buy back for even a couple of percent off. But the reward was potentially thousands of dollars, and that's a lot of money by any standard. And I want to illustrate the point that crypto investing is not easy. Trading isn't easy, and it has its risks involved as well. Nobody can teach you to make a successful trade, especially nobody online who is charging $50 for the privilege. And hey, if you're new to the channel and you're enjoying this video so far, we have a lot more VET and general investing content out on a daily basis, so be sure to subscribe for that. So anyway, when we break it down, a successful trade relies upon being able to spot an inefficiency in the ability of the market to fairly value an asset. In other words, successful trades rely upon the investor being able to find opportunities on a regular basis, where the reward and potential for gain is on a statistical and objective basis better than the risk. And this, by its very nature, isn't an easy thing to do, because of course when opportunities like this do pop up in the market, there are tens of thousands, maybe hundreds of thousands of people scouring the market daily looking for these opportunities, and so they tend to be capitalized on very quickly and are not around for very long. But just understanding the way in which the market works puts any investor ahead of the majority of people coming into crypto. A lot of people think that crypto trading is always gambling, and that misunderstanding prevents them from doing it, which then creates opportunities for those who do understand that trading can be gambling, but it can also be sound investing, if the investor is buying opportunities which are statistically favorable, and there is a proven method to their approach. I continue to be amazed in ever greater proportions as to how many people and investors in the crypto market just don't understand that the market isn't a casino. It's a group of people trading assets with each other, and these people all have their own beliefs and theories, and the market is subject to herd mentality, and also to the fear of missing out, and all of these other psychological tendencies, and this creates inefficiencies in the market, which then translate into statistically favorable opportunities which can be capitalized on by investors who do understand this, and who can successfully identify them. And the thing is, some of these opportunities are short-term and others are long-term, and it's not the time frame of the investment which is important, it's the favorability to the investor that matters in my view. And just by understanding that basic information, any investor is already way ahead of the competition on average. Because most people see that some people are treating the market like a casino, and so they conclude that the market must be one giant casino then, and not that it really does depend upon the behavior of each person within the market. And just like in real estate or the stock market, you have some people who have no idea what they are doing and are speculating and making crazy high-risk decisions every single day, and then you have others who are using proven principle to invest. Thanks for watching, and if you're not yet subscribed to the channel, then be sure to do so as you don't want to miss out on any more of our content. See you in the next video.